Thanks, guys. So I'm Stuart. I'm the founder of OpenForest. I've been a barrister for the past 15 years or so and spent over a decade in Ireland's largest law firms. For the past 2 years, I've been the founder of OpenForest. The idea behind OpenForest is that you come with a business idea and we set up the company for you and then do all of the legal, the tax, and the accounting all under one roof in the one place. And the idea is to try and delay the need for founders to go to accountants and lawyers and start spending a lot of fees when they don't need to, all for this kind of low end stuff. And so we try and tackle that. So what I'm going to talk about today is generally what a limited company is and how to go register one. And even if you have registered one already, that's okay because what this will probably highlight for you is mistakes that you probably will have made along the way. It will show you the exposures that your company has at the moment, and you'll be able to figure out whether they're serious or how quickly you have to go and fix them. And then I'm going to go into a little bit of general structural advice on the company and what you need to know to give yourself the best chance of being in solid control of your company through your business journey. And then I'm going to talk a little bit about the share structures and as you saw on the title of this talk, how a founder can lose control of their company in the future if they're not careful in the earliest stages. So, just a quick little introduction. 90% of businesses in Ireland are either sole trader businesses or limited company businesses. And of those 90%, it's shared around 50-50 between sole traders and limited companies. A sole trader generally just means that you're operating the business as yourself, as a person, while a limited company is this additional structure that's built and it's placed in front of you, between you, which is behind the business, and the rest of the world, which is out there. This is like a stopgap structure that's there for various reasons. Now, the difference between them is you can do either, but it's not necessarily a progression. You at the very start can pick and look and say, okay, this is more suitable for my business and this is more suitable for mine. And the reason a limited company would be more suitable for you is if you're going to get a lot of revenue, anything over, it's an art, but 60, 70,000 per year, when it lands in the company structure, there's a lot more flexibility there for when you pay yourself and what you do with it. While if you're a sole trader and you got, let's say, 100,000 euro in revenue for the year, immediately that's taxed at your personal income tax level. And so there's no flexibility there. So a limited company is good for that. A limited company is essential if you have intellectual property in the company, if you want a partner and you want to give maybe employee shares, or you want to take an investment and you're going to give an investor some shares. The limited company is the only way to do that. And so from the very start, you would say a limited company route is for me. And then the only question is, when do I actually do it? And you kind of try and delay it. There's a bit of a balance, but as soon as you've got actual real demand for your product or your service, it's time to set up a limited company. And we should just say that if you do it, sometimes it's a bit scary, but worst case scenario, it costs around 200 or 250 euro to close it down. If it's been trading a long time and it's making a lot of money, it might cost a bit more than that, but that's okay. But at the very start, if the business fails, 200 euro to close it down, or you can keep it there for repurposing in the future. It could become your holding company or something like that. So just to say, don't be afraid of it. Now, the real difference between a limited company and a sole trader is the clue is in the name of it. It's the limited. A limited company means that your liability as the shareholder of the company is limited to the amount of money you put in. And usually you only put in a small amount of money. Usually it's a nominal amount, like 100 euro or €1, something like that. And it essentially means that if your business is doing something that's maybe kind of risky, let's say even you're something like a mechanic and you fix a car and you drive out of the garage, the owner drives out of the garage and the wheel comes off. That's your responsibility. It's your business that was negligent. You're supposed to be a mechanic. You put the wheel on incorrectly. So they'll sue your business. Now, if you're a sole trader, you're going to get hit personally for that, and any of your assets that you've built up in your life to that point, they're at risk. But if you have a limited company in place, that limited company gets sued. Your assets are safe behind the scenes. Your house, your car, everything is safe, assuming that you haven't done anything fraudulent or negligent. And because your assets are safe, that just means you can take a little bit more risk. The purpose of a limited company when it was established way back over 100 years ago was because businesses are inherently risky. And so if starting your own businesses was really risky, people wouldn't do it. So they needed this concept to allow founders to step into that world, and a limited company is a structure that lets you do it. So, like I said, so long as you're not trading negligently or you're not trading fraudulently, for example, you know your company is insolvent, you know there's no money left and there's nothing else coming in, then you go and get stuff on credit. That's not okay. So then the authorities can look behind this limited company shield. It's the shield that protects you. They can look behind that. So long as you're just giving the best efforts in terms of trading, then your assets are safe. So just a couple of quick points on setting up a company. Um, you have to have a registered office in Ireland, and it can't be a PO box, but you can outsource it to an office provider. You need to have a company secretary in place. And if you're the sole director, you need to either appoint a second director or you need to have a different company secretary. And the idea there is just to have two sets of eyes in every company. Now, a lot of times people ask me, can I appoint my wife or my husband or a family member as company secretary? And the answer technically is yes, you can. There's no legal requirements in terms of knowledge or certificates or anything like that to be a company secretary. But the law does say that you, as a director of your company, are responsible for appointing somebody with the correct skills and knowledge to do the job. So, really, it's incumbent on you, as the leader of the company, to appoint somebody here that knows what they're doing. Then, on the management of the company, it's split into between shareholders and directors. The shareholders are the owners of the company, while the directors run the day-to-day of the company. Depending on how small your company is, this might be a strange concept to you because you might think, well, that's just me. It's just me or my co-founder. There's only two of us. But when moving on from this talk, you should think that these two functions are two different hats. And even though it might be just you, you should try and think, I'm doing this task as a shareholder, I'm doing this task as a director. They're very different things. And where they materialize is usually if you want to do anything for your company, for example, adding a new director or changing the name of the company or giving shares out to somebody, there is a procedure for that. And the procedure is either set out in the law, which is in the Companies Acts, or in your company's document, which is called the Constitution. And how to achieve stuff is set out in that. And it will say, for example, want to change a name? Okay, you need a shareholder approval. Want to appoint a director? Okay, you need a director approval. And so it's important that you split those roles in your head and you say, I'm doing this as a shareholder or I'm doing this as a director. And even if it happens to be the same person, that's okay. But don't think about it like that from the start. Try and have that divide in your head. Now, people often ask, how do I constitute a formal board? And actually, the answer is The directors that are there from the very start are the board. That's a formal board. You actually appoint a board from the very start. It's just the directors. You can build up more complex boards with different types of delegated groups or bring in nominee directors and shadow directors and all of that stuff. But that's way beyond this. For now, whoever is appointed at the very start, that's the board. It can be one person, it could be way more. As I mentioned before, there is a concept of shareholders and directors. The shareholders are the real owners of a company. They're the ones with the real power, and they appoint the board to run the business of the company. And so you might have a picture of a shareholder kicking back in a hammock while the directors do all the work, and that's true to some extent. And you can see here that directors have duties under law, and it's a very serious position to be a director. And your duties are to act responsibly for the shareholders. Now, again, it might be just you at the start, so it kind of feels like a weird concept. But when you bring in investors, when you bring in and you give shares to your employees, your duty as a director is to make decisions that are best for everyone, best for the shareholders as a whole. And then there's other duties that are in law. You've got to act honestly, you've got to act in good faith. You can go to section 228 of the Companies Act and read the list, or you can just Google it and ChatGPT will tell you what the list is. And so you should do that at least once, just so you know it in the back of your head. Okay, before we talk about losing control of companies, stuff like that, it's important to get a understanding of this share structure concept. This is the tricky part. I don't think anyone is expected to walk away from this with a full, complete understanding of what we're about to talk about here. But this will probably be the only time in your business career that somebody's going to explain this to you. So, to the best of your ability, take what you can from this. I recognize that it is a bit of a tricky concept, and it goes even deeper than this, but this is the light way. So what I'm going to explain now in a not so perfect metaphor is what the underlying structure of a company looks like, kind of like the engine of a company. And it's all set out in one document called the company constitution. And so my metaphor here is like a concert. And so I'm just gonna kind of make it relate to see if it makes it a bit easier. So the constitution is the rule book of the company, and you can think about it like the stage times or the exit locations of a venue and all of the technical details of how the venue runs. And your company is the band in this case, right? So within the constitution, within the concert arena, when you're creating it, you decide what the amount of authorized shares is. Now, the authorized shares means what's the maximum amount of shares this company is ever going to be able to issue. It can be changed in the future expensively, but at the very start, you're asked, how many shares can your company ever give out? So it's kind of like saying, what's the maximum capacity of this new stadium that you're trying to build? Is it going to be a small, intimate venue of 100 chairs or 100 seats? Is it going to be 80,000 seater? Is there no seats at all? Is it an open air concert? An open air concert would be like setting no authorized maximum shares. So you don't have to specify. People make a mistake, in my opinion, all the time of setting an authorized shares. So they might say, okay, this company is divided into 100 shares. That means you're setting a maximum of 100 or a million shares. In Irish law, you don't have to set a maximum at all. You can just stay silent on it. I'll show you what that looks like on the next slide. But that's the most flexible thing to do. So bear in mind, if you're starting a company, when you're on the CRO website going through it, you are asked this question. Okay, so the authorized shares, maximum amount of shares. Of the maximum, so let's say of the 80,000 seater stadium, how many tickets are you going to give out right now? Because you can have an 80,000 seat stadium and just not sell all the tickets immediately. And that's the issued shares. The issued shares is how many shares are you going to give people right now, today, on day one of the company? And then to make it more complicated, each of those shares is a different type of share or a class of share. And just think about this like, is the ticket a VIP ticket? Is it standing room? Is it, one of the cheap tickets that are blocked from view? Same kind of thing here. And then the final concept is par value. You probably heard about it before. It's par value or nominal value. And this is the initial amount that's set on each of the shares. And the best way to think about this is think about something like the Oasis concert that was here last year. Each of those Oasis tickets had a number, an amount printed on it. I don't know what it was, but I know they were expensive, right? So let's say it was €100 that was printed on the ticket. That's like the par value of the ticket. But then you probably know that these people bought those tickets for €100 and then went to the concert and stood outside and sold them to desperate people for €400. The €400 is the market value. That's because there's supply and demand for those tickets. Same way as you're going to try and build up your company to be a profitable company and be attractive to investors, your market value goes up. But when you look at the ticket, it still has the par value printed on it in black and white all the time, and that doesn't change. And that's the same as a share. Your share could be valued at 1 cent, but you could have people willing to pay €1 or €100 for that shares. And if that's the case, that's congratulations to you. Your company is very valuable. You've 100x, 1000x the company. But that's the concept. So that's the general share structure. I know there's a lot there. Throw whatever questions you have into the chat, and I'll try and have a read at the end. Well, try and take what you can away from that. Now, the next slide is going to talk about authorized shares because this is a big, expensive mistake that I see all the time. So just remember, authorized shares is the maximum amount of shares in a company that can be issued. So if you have a company already, your constitution has a sentence, probably paragraph 4, that looks something like this. The problem with the top one, which is a very expensive mistake or can be an expensive mistake, is that it says the share capital of the company is divided into 100 shares. That's like saying that your company is a pizza and the pizza slices are sliced into 100. And normally, what happens when this is the case is that the founders, the initial founders, are given all of the shares. So, your accountant, let's say, the accountants are guilty of this all the time. They divide a company into 100 shares and they issue 50 to one founder, or 50 to the other, or 100 to the founder. And the first time this will present itself as a problem to you, probably, is if you go on to the PSSF and you get approved for the 100K PSSF from Enterprise Ireland. Because Enterprise Ireland's lawyers will come to you and say, okay, congratulations, here's your €100,000. Now, a slight technical point. Please confirm to me that your company has headroom in it for Enterprise Ireland to get shares when the investment is a thing called a CLN, and it basically means it's a kind of a loan, and at some point in the future, the loan will convert into new shares of your company. And so they say, okay, well, when that converts in the future, tell me that you have shares to give me. And if your constitution looks like the top one here, then you can't say that. You say, sorry, I've given all my shares out already. Real sorry about that. What that means is that you've got a very expensive restructuring on your hands. It's gonna cost you a couple of thousand. You just have to go to a lawyer, and the lawyer has to basically undo your documents and fix it. It's just a time draw. There's no way of doing that easier. So the top one is very wrong and very bad. It could be fine if you're just a cafe, something like that. You don't need investment, that kind of stuff. It's probably fine. You won't notice it. But if you're a high growth company, it's going to be a problem for you real soon. Now, the bottom one is what it should look like. You'll see it says the share capital of the company is divided into shares, an unspecified amount of shares. It doesn't say. That means that you haven't specified what the maximum amount of shares is, and that means there is no maximum. You'd be forgiven for not knowing this because how the hell would you? But that is the technical legal point of this. It's just very hard to know. So I would check your constitutions and just have a look for this. If it is like the top one and you do need investment in the future or you're going to get PSSF, just know that it's an exposure and it can be fixed right before you do get PSSF. So I wouldn't rush out to spend the money now to fix it, but if you get approved for PSSF, just know that you're going to have to run to a lawyer and get this done. The first one. I'm just going to quickly read the chats. Someone says, in the context of share capital, if you don't specify the number of shares, how do you equate ownership? Okay, good question. You don't specify the authorized shares, but you do specify how many shares are being given out at the very start, and that's the percentage. So you can have unspecified authorized shares, unlimited shares, you can give them. But if you give somebody at the very start, you give founder A 50 shares and founder B 50 shares, they are 50-50 owners. If you give founder A 1,000 shares, founder B 1,000 shares, 50-50 owners. Just math. But that's the issued shares. That's you saying at the start, I'm now issuing you with this shares, and I'm now issuing you with that shares. That's your percentage. And if you go and issue with an angel with more shares, you got to bring in that percentage into the wheel, and then everyone gets diluted down. In which case would it make sense to stipulate? Yeah, great question. Don't do it. There is zero benefit to doing it. I don't know why people do it. You don't have to. Nobody in the UK does it. You just don't need to do it here. I know of zero reasons to do it. Okay. Okay, the formatting has gone a little bit funny here, but we're now talking about the classes of shares. So again, we've gone down from authorized shares to the issue shares. Now we're in the classes of shares. So you might hear stuff like ordinary shares or pref shares or class A shares and all these kind of terms. What you need to know is that the names are actually completely meaningless. They could be called anything. You could call them the chicken shares if you wanted to. Irrelevant. What you have to do when there's a reference to a named share, like the pref shares, is you got to get the constitution out. The constitution will create the pref shares. You got to read the document all the way down. It's a big document, and you got to see pref shares. There's a clause or a paragraph, and it will tell you what is the preference. Like, why is this share named something different to the ordinary shares? The ordinary shares are usually the standard. Why is there a pref share class here? What does it do? You got to read down and you got to say, oh, this pref share class says that the investors get 2x their investment back. So you really need to read down the documents and say, this is why it is a pref. This is why it has a preference. Because it says it gets twice the money back before I, as a founder, get my money back. Now, what's on the screen here in front of you is generally speaking what it might look like. This is the structure we set up for OpenForest companies when they come through. But this isn't the way it is. This is just our way. There's a million ways to do this. Generally speaking, the ordinary shares are there from the very start. All the founders will get them, and they have voting rights. That's really important for what we're going to talk about next. You can get dividends if your company ever grows big enough to be able to pay dividends from profits. You'll see there's no liquidation preference here. It doesn't make sense. But then on the investor gets that. And then employees, they don't really get anything except they get to participate when you sell the company and they get some exit money. That's the way it kind of should be, but that's very light. So there's a a million different ways to do that. So I just wanted to show you this just as a quick introduction. Okay, so um, so this is possibly where you're exposed with the share classes. So here it's assumed that the founders will get the ordinary shares. That's the normal course of things. If you're taking on an investor or if you're taking on an employee and you want to give them some shares, which is super common, you really, really, really have to be careful not to give them voting shares to the extent possible. We'll talk about it in a minute a bit more. But you have to try and retain the voting shares for yourself, for the founder team, as long as you can. And I'll show you why. This is an example. Let's say the wheel on the left here is a typical example of what a company might look like on day one, founder two, or just one founder or whatever. You see on the bottom, they've got only have ordinary shares, right? And I say ordinary shares is just the standard one that people are incorporated with. Because there's only one share class, that means all the votes and all the power is in there because somebody has to have the power. Now here you see they've got voting power and they've got economic power. The economic just means you've got the rights to the cash. If you sell the company, you sell your shares, you're getting the cash. That's all. Fast forward a year to the image on the right. Let's say you've brought on an investor for around 20%. This is all very simplified. You brought on an investor for 20% and you've maybe given two employees 3% each, the first developers or whatever. Here you have a situation where the founders now have 74% of the company remaining. If these founders were asleep at the wheel and gave out their ordinary shares, they gave the investor and the employees the same shares as they have because they only have ordinary shares in the company because that's all they've created at the start. Now they're in a situation where they only have 74% of the company. And if you look at the top, it mentions a constitution amendment. If you want to change the name of your company, you have to do a constitution amendment. And when you read the law or when you read your company constitution, it will say, oh, okay, you want to change the company name? If you want to change the company name, you have to do what's called a special resolution. This is written in the law. Anybody can go to the Companies Act, open it up and read this. This is where this rule comes from. So it says, change your name, special resolution. And it says, what's a special resolution? You read the law and it says 75% of the voting members. So in this scenario on the right, you have a situation where the founders do not have the ability to change the company name, their own company name, because they've accidentally given away voting power to the investor and to the two employees. Silly situation. Now, that's not to say that the investor and the employees won't say, oh yeah, it's only a name change, no problem. Like, of course I'll agree to that. And they sign the shareholder resolution and everyone's happy. But the point is you're exposed there. It shouldn't be the case. You could have avoided that by creating a second share class or a third share class and given those non-voting shares here, the investor shares with no votes, give them to the investor and create a third share class for employees that doesn't have votes or dividends or preferences, just has exit cash. That's all they care about. That's all they want. Give that to the employees. Then the pie chart still looks like the left. The voting pie chart still looks like the left. Founder one has ordinary shares. They're the ones with the votes. Founder two has ordinary shares. They're the ones with the votes. So they don't have to consult everybody else when they're voting for something like a special resolution. Okay, that's ridiculous scenario number one. A little bit ridiculous. This scenario is where it gets real bad. On the right, let's say we're moving forward another year or two. Now you have a second investor in. Now you've given your full 10% employee pool out to invest or out to employees. Now you're in a situation where the founders have been diluted to 50%. If you want to remove a director of your company, The law says that you do it by what's called an ordinary resolution, much lower barrier than a special resolution, and that's 50% of the voting shares. So now these founders that were asleep at the wheel and gave out ordinary shares like they're going out of fashion, now they have an exposure whereby the two investors and the employees have the power to come together, do a vote, and remove the directors from their own board. That's how it happens. That's when you watch the Facebook movie, and that is how it happens. So the point here, there's a couple of points. If you're taking a big investment from a VC or from an experienced angel, you can't say to them, hang on, I listened to a talk by Stuart and he said I don't give out voting shares. So sorry, because they'll say, okay, well then you're not going to get the million. And so like, what do you want? Do you want the million or do you want, I want voting shares. I want to be protected. So give me voting shares. That situation might arise, and that is what it is, right? If it's a David and Goliath thing, if you need the money and they're professional investors and they recognize that they want voting shares, then it's a call for you to make as to whether you need the money and you want to give those shares out. That might happen, and that's okay. I think the point is in the early stages, the earliest stages, when you're feeling generous and you want to give the first angel who could be a good friend, or you want to give early employees or family and friends, you want to give them some shares. Really, really important voting shares at that point until you're asked. Even if I was taking a VC investment, I would attempt to give them shares that are not voting shares initially, and then I would let them negotiate with me for voting shares rather than give them out at the start. So the point is to try and retain the voting shares as long as possible. Um, I'm just going to read some of the chats just to see if I'm missing anything.
Hi Stuart, just to come in there, there's a couple
Yeah,
of questions in the Q&A section as
yeah.
well.
Oh, there's a Q&A
And then
section.
there's a couple of questions in the chat just so we don't miss any of them. I know people have
Okay.
been asking lots of really,
I'm
really
looking at
great
the.
so far, thanks.
Oh, I see the Q&A. Yeah. Okay, I'm looking at the chat. So I'll just run through a few of these. I'm in the chat. Does a share option pool, as opposed to giving shares to employees, somewhat mitigate this? No, it doesn't. So long as when you're setting your share option pool up, that's a document with a bunch of rules. That's all a share pool is, right? So there is this document probably called the ESOP. And the ESOP, if you've ever heard of creating an ESOP, it's just a document. And usually the document says, oh, we're earmarking 10% of the shares for founders. But the rules of the ESOP will say this, the ESOP relates to these shares. And so if you say the ESOP relates to the ordinary shares with the votes, you're going to be in the exact same problem. So you need, at the structure level, to create additional share classes. Let's call it an E share class or whatever. It doesn't matter what the name is. You just have to make sure when you read the Constitution that the E share class doesn't have votes. That's the most important part, right? So to create all of these, you need a new Constitution. That's where they're created. Um, okay, where's the Q&A? Can you explain what a holding company is? Yes, easily. A holding company is a totally normal limited company, the exact same type of company that we're talking about here. The only difference is a holding company holds something. That's actually what it is. It either holds your shares, so that's a personal holding company where it holds the shares in your trading company, or if the holding company only holds shares in the trading company, that's kind of what's called a group holding company. So you might have the group company here, and then underneath is the trading company, and you can do that for various tax reasons. I know we don't have much time to go through all of this, so I have to kind of answer short. I appreciate that they're complex topics, but I'll just do the best I can as quickly as I can. What's the benefit of determining the authorized shares if it's not compulsory? There's no benefit, absolutely none. And let's see, in which case, yeah, so same question, in which case would it make sense to stipulate the number? Doesn't make sense. Don't do it. You just don't need to. And where would you find out your current share structure if you're not sure? Yeah, you just open your constitution up. And I mean, if you don't know, it's probably just ordinary shares. So you'll open it up, you'll go to clause 4, and it might say something like the share capital of the company is divided into ordinary shares. Or if it doesn't say what the name of the shares are or the type, they're probably ordinary shares. You have to go to your CRO document, and when your company was incorporated, there'll be a document called the A1, and in that, somebody will have typed in the name of the shares, and it's probably ordinary. All right. Uh,
Stuart, sorry, just to come in there really quickly. Somebody has said in the chat function that they're still registered as a sole trader, and will they face issues dealing with larger companies? And do they prefer to trade with incorporated businesses? So just that's
yeah,
an important one.
not necessarily. It totally depends on what you're doing. For example, it might make sense to be a sole trader if you're a tradesperson. If you're like an electrician or something, it might make sense to be a sole trader. And then I think bigger companies, if you got a job on a big, huge site, they wouldn't, I don't think they'd blink at you being a sole trader for that reason. But it would be different kind of considerations as to whether you switch. Like, for example, if you were an electrician and you got a big contract, is the contract worth a couple of 100 grand? If it is and you're a sole trader, every euro you get is taxed at income tax level. So you'll be find yourself being taxed at 52% real quick, like after 45K or whatever it is. While if that goes into a company, it sits in the company first. Now, yeah, you get taxed 12.5% at the company level, but you've got all the flexibility in the world as to when you pay yourself, how much you pay yourself, whether you put that into a pension pot. There's loads of flexibility there on the tax side. So it's not about your kind of it can be about your customers, but it's not necessarily. It's closer to home, the reasons why you do it. Let me see. We don't have too many slides left anyway, guys, so I'll answer one or two more in the chat. And then that's obviously the trickiest part. After this, it's kind of okay. So does a share option pool, as opposed to giving shares to employees, sorry, we answered that one. Is it possible common to create shares where the economic power is different than the voting power? So the economic power and voting power are different fundamentally, but it's possible and advised to have two different share classes or more. One is the voting power, that's what the founders have. And then you would create a class that doesn't have any voting power, still has economic benefit. So, in other words, if you sell the company, the people holding those shares still get the payout. But yeah, you would separate it, and then you can give those shares out as much as you want, so long as it, fits. It will still dilute you, but they don't take votes as well. You don't have to go to that person and say, "Hey, I want to do something with my company. Will you please approve this?" Um, and then let's see from Paul. If set up a company with two founders, issued 1,000 ordinary shares at 1 cent, is that enough shares? So what you need to do, Paul, is you've issued 1,000 shares. So going back to this one, from your post, you say you've issued 1,000 shares. That's fine. You need to check whether you've set an authorized shares. So you need to check this sentence of your constitution. And if the top one says the share capital of the company is divided into 1,000 shares, that's you've authorized 1,000 instead of issued it. So if you want, I'll give you guys a link to me on LinkedIn after this, and you can just reach out and send me this page of your constitution, and I'll tell you in 1 second what your structure looks like. I know this is complicated. This is complex law. So, like I said at the start, just take what you can from this. Know that you might have an exposure, and then you can figure it out from there. But this is meant to be confusing. It is corporate law.
There's a couple of questions about PSSF as well. If you've gone for PSSF and it hasn't come through yet, should you wait to tidy it up? Should you tidy up now or wait till it comes through?
Yeah, so wait till it comes through. Wait until they come to you and say, yeah, you've been approved for PSSF. you're kind of on the clock then. So you'd need to run to a law firm and say, hey, I think I'm exposed on my constitution. It's limited here. So, does that need to be fixed? Or say it to your development advisor. So like we got PSSF, NDRC, I've been through all of it, right? So kind of we know this stuff, but just keep an eye on that. And does EI mandate the type of shares they require? No, they don't, but they just say, uh, prove to me that you have the extra headroom in there for us to convert into in the future. But they don't say it needs. I don't think they do, but they might do. But that's not to be worried about anyway. Okay, I'll just jump on. Just a couple of things to note immediately after incorporation. So like we said at the start, you might be incorporated already, but there's no harm in making sure that you've done these or you know your exposure if you haven't. So from day one, you got to create certain registers, register of directors, register of shareholders, register of company secretaries, and there are specific pieces of information that you have to include in those registers. If you don't have it done, and I know that's a ton of you, it is technically a breach of the Companies Acts. This isn't the type of thing that somebody kicks in your door and says, "Show me your registers," but still, it is it is bad governance. It does mean you're non-compliant with the act, and so you should do this just as a matter of good corporate governance. It's like maintaining your car engine, right? Like you can put your head in the sand and keep driving all the while, oil needs to be changed and you just keep driving long enough and something will happen. So the registers are there. What to put in them? You go to the Companies Act, so you read where it says register of directors. It tells you the information to put in it, and then that's your template going forward. And the registers are like a Bitcoin ledger. It records every change when it happened and stuff like that. So it's a ledger is exactly what it is. Within 2 months of anybody getting issued shares, so this is when you incorporate, plus if you give out shares to anybody later on, you have to prepare and deliver a share certificate to them. Just a little, you can get a template online. Got to do that. Within 5 months of incorporation, you have to file the details of the beneficial owners of the company. Not necessarily the same as the shareholders. Your shareholder could be a company, but what this RBO thing, you might have heard it called the RBO, that looks for the real people. It wants to know, I don't care if you have a company as a shareholder, who's behind the company. And if you say, ha, another company, 10 companies, they say, all right, let's go all the way down. We want to know who the person is. And so they find the natural person and they identify that person and you file details of that person on the register. The reason for that is that massive level of oversight is like global anti-money laundering reasons. The whole world has kind of gone down this path and they want to know that people aren't doing shady stuff with companies, Panama paper stuff, that's all related to this. Um, Super important, the annual return. If you take anything away, go away today and just check your annual return date for those of you that have a company. So when you incorporate your company, precisely 6 months later, this window opens. It's a 56-day window. And it says you've got to file your annual return within this 56-day window. Annual return just means yearly filing, right? That's all it is. It's just, hey, let me know if there's been any updates to your company, any new directors, any new shares given out. Did you make any political donations? There's 20 questions or something like that, right? So you got to file it. The real problem with missing this, and maybe one or two of you have before, it descends into a pit of disaster because you get a fine the moment after you're late. They can't undo it. So they say you're deemed under law to be late. So there's no like the dog ate my annual return, please. None of that. It's like immediately you're late. You get fined every day up to like €1,200. That's the easy bit. The real bad bit about this is that we as small, we as tiny companies, we're probably called a micro company. It's a legal definition when your revenue is under 900K and you've less than 10 employees and a few other things. So we're probably all micro companies here. And the beautiful thing is, if you're a micro company, at the end of the year, when you do your accounts, and you maybe only made a little bit of money, you can do them yourself if you're competent as a director, or you can pay a little bit to an accountant to do your accounts for you. But you don't have to go to an auditor and pay an extra auditor because micro companies are exempt from doing that. It's a really nice exemption. If you're late on your annual return filing, you lose that exemption for 2 years. And so even if your company hasn't done anything and you've big fat zeros on your account, you got to go and pay a couple of grand twice to an auditor for them to stamp your zeros. And that is a very, very expensive mistake. So find out what your annual return date is. Set a ton of calendar reminders about it. You have to submit financial statements with the second and subsequent ones. So give yourself plenty of time for that, but just make sure that you never miss that. It's a real bad one. You can't close your company down or anything if you've missed it. So you can't just walk away and it'll be all be okay. It just descends constantly and then you're stuck. So you've got to make sure that that's looked after. Um, Corporation tax within 30 days of trading, that's a little bit vague, but what we think it means is 30 days from the point in time when you are open for business, whatever that means, right? So if you set up the company and you're still building a product and you can't sell anything, it's probably not trading. But from the moment your shop is open, you have to register for corporation tax. In practice, what normally happens is people incorporate and register for corporation tax within those 30 days just to avoid any questions from revenue. And then VAT, there's a threshold. If you cross it or you're near crossing it, you have to register. PAYE, you have to register for employer taxes if you're going to pay yourself as a director or if you're going to pay any employees. So just a couple of things to watch out for there. That's kind of all within the first 6 months. After that, it's really just your annual return every year, and then any updates to registers or updates to the RBO filing and stuff like that. Um, we can quickly, this is the last slide, so we can quickly talk about first agreements. So two important ones. Let's talk about the IP assignment agreement. It's a kind of a weird quirk of Irish law that IP rests with the creator. And so what that essentially means is if you outsource, let's say, the creation of your company logo, or you outsource somebody to create software for your company, technically speaking, under Irish law, they own the IP rights to that creation. And so your job as a founder is to make sure that somewhere they have assigned the rights of that to your company. The same goes for the founders. You need to assign the IP that you're creating that's going to rest with you. You need to assign that to the company as well. That's usually done in a founders agreement. But so anybody you hire on Upwork, anybody you hire on any of those other platforms to create logos, get them to sign that agreement, or maybe check the T&Cs to make sure that, Upwork automatically transfers IP over. But that's really important because you might find in 5 years when an investor says, show me your IP. Yeah, they mean show me your registered trademarks or show me any patents you have. But they also mean show me the folder with all of the IP agreements and maybe an Excel sheet that says logo, this person transferred via this agreement. Code, this person transferred via this agreement. That's good governance if you do that. But it's just so you can say the website was transferred here, the code was transferred here, the company owns it, because that's probably what the investor is going to, or the future acquirer is going to be buying. So just look out for that one. It's best to do that while you have leverage. In other words, you haven't paid the people already. If you've already paid somebody and you have to try and go back and get them to sign it now, you might find yourself in a bit of difficulty. And then finally, people say all the time, do I need a shareholders agreement? What do I need? Founders agreement is what you need when it's just the founders at that point in time, and the shareholders agreement is like the bigger brother or the bigger sister to that. And that's used for when external parties are coming in. For example, an investor is coming in, you'll put the shareholders agreement in place. That document you need to go to a lawyer for because that is very serious business. The founders agreement, on the other hand, it's still serious. It's still a legal document. It's still legally binding, but it's a little bit more flexible in terms of there's no real guidance in law as to what should go in there. It's basically you and your co-founders sitting around the table and saying, what do we agree? Let's talk it out. And whatever you guys agree, that's what happens. So some things you might want to consider are what the vesting period will be. In other words, yeah, you guys get shares at the start, but can you walk away the next day with all the shares? No. You usually put in a thing called a reverse vest, and that means if somebody leaves after 6 months, they void their shares. They don't get the shares. They get to claw the shares back into the company because if a founder leaves, that's a big problem for the company. Or how to resolve disputes. Do you need an arbitrator? If you do, is their decision final? There's loads of things. Death. What happens if one of you unfortunately die? Because your shares are your assets, so they're going to transfer. And so if they do transfer, does that mean somebody, a family member, gets to all of a sudden be in the company and making decisions when they don't know about the company? That wouldn't work. So you have to have some mechanisms in place here to look after the company. Do what's at the company's interests at heart. That's the best way to do this.